Welcome to Essential Biz Marketing. Today, we begin exploring how exchange rates impact global business decisions. Understanding this will help you grasp why currencies matter in trade and strategy. Let's start with what you'll learn in this chapter. This chapter explains why exchange rates matter in business activities. You will also learn about the key factors that influence exchange rate movements. Here's what we'll focus on next. We'll analyze how inflation, interest rates, and purchasing power interact to shape exchange rates. By the end, you'll be able to assess business risks and opportunities tied to currency changes. Let's begin with the birth of a new currency. The euro was introduced as Europe's single currency and initially traded at parity with the US dollar. Its value later rose to $1.57, reflecting confidence in Eurozone growth and stability. But the euro's journey wasn't smooth. The global credit crisis and recession exposed weaknesses in Europe's economy. Heavily indebted countries like Greece and Italy struggled, causing the euro to fall to about $1.10 by 2017. After the fall, signs of recovery emerged. Despite volatility, financial markets began to stabilize. Analysts forecasted a rise in the euro's value, aiming for $1.18. Let's shift to long-term business impacts. The euro eliminated exchange rate risks for EU firms and improved financial planning. It also enhanced competitiveness through cross-border mergers and economies of scale. A weak euro wasn't all bad news. It made European exports more affordable on the global market. This helped many firms regain lost market share and rebuild export momentum. Let's now explore the core concept of this chapter. Exchange rates determine the value of international trade transactions. A weak currency makes exports cheaper and more attractive, while a strong currency lowers import costs but hurts export competitiveness. Let's illustrate this with a pricing example. When the exchange rate is stable at 1,201 per $1, a Hyundai Elantra priced at $36 million, one equals $30,000. Just like the Chevrolet Malibu. At this rate, neither country gains a pricing advantage in trade. Now let's see what happens when the exchange rate changes. As the Korean won weakens to 1,501 per $1, the dollar gains strength. The Elantra and Malibu still cost the same in local markets, so trade remains balanced, for now. Now the price gap starts to emerge. The Elantra stays at $36 million won, now worth only $20,000 due to the weaker one. Meanwhile, the Malibu still costs $30,000, which equals 45 million won, making the US car more expensive in Korea and boosting Korean export appeal. Now we see the real impact on trade flow. At 1,501 per $1, the Elantra is now $10,000 cheaper than the Malibu. This price gap drives US consumers to favor Korean cars, increasing Korean exports and American imports. Let's reinforce the trade effects of a weaker won. The Elantra, now priced at $20,000, gains strong appeal over the $30,000 Malibu. As a result, Korean exports rise while the US imports more, confirming that a weaker won boosts Korea's global trade position. Now let's look at how firms use exchange rates strategically. Companies may source raw materials from countries with weaker currencies to lower costs. They also target markets with stronger currencies to maximize revenue and profit margins. Let's see how exchange rates affect overseas revenue. Tesla earns 6 million yen in Japan, which converts to $60,000 at a rate of 100 yen per $1. This amount is then remitted back to the US, reflecting stable earnings in dollar terms. Let's see how a strong yen affects Tesla's earnings. At 100 yen per $1, 6 million yen in sales converts to $60,000. A stronger yen means Tesla gains more when remitting profits back to the US. Now the exchange rate begins to shift. If the yen weakens to 150 yen per $1, the same 6 million yen will convert to fewer US dollars. Let's see the result of a weaker yen. When the exchange rate drops to 150 yen per $1, Tesla's 6 million yen now converts to only $40,000. This means the same sales in Japan bring in lower profits for the US headquarters. Let's summarize what just happened. Even though Tesla's revenue in yen stays the same, a weaker yen reduces the dollar value after conversion. This exchange rate loss directly cuts into the company's overall profitability. Now let's shift from firms to government actions. Governments sometimes devalue their currency, intentionally lowering its value, to boost exports. This makes domestic goods cheaper for foreign buyers, increasing global competitiveness. Let's look at how devaluation affects real trade. At an exchange rate of 6.5 yen per dollar, both Haier and GE products cost the same, $600. In this case, there's no price advantage, and trade remains balanced. Now the exchange rate changes. China devalues the yuan from 6.5 to 7.5 per US dollar. Let's compare prices after the yuan's devaluation. Haier's products still cost 3,900 CNY, but now equals just 520 US dollars, cheaper for US buyers. Meanwhile, GE's $600 product now costs 4,500 CNY, more expensive for Chinese buyers. Now price differences start driving trade shifts. With Haier now cheaper than GE, US demand for Haier rises. This leads to more Chinese exports and more US imports. Let's summarize the trade impact of devaluation. Haier's lower price gives it a strong edge in the US market. As a result, Haier gains sales while GE faces stiffer competition. Now let's look at the opposite policy, revaluation. Governments may raise their currency's value to make imports cheaper for domestic consumers. Let's compare prices under the new exchange rate. At 7.5 yuan per dollar, Haier's 3,900 CNY product now equals just $520. Meanwhile, GE's $600 product costs 4,500 CNY, making Haier more affordable in both markets. Now let's see how price gaps affect trade. With Haier priced lower than GE, US consumers shift toward Chinese products. This boosts Chinese exports and leads to higher US imports. Let's reinforce the main outcome. A weaker yuan lowers Haier's price, giving it an advantage over GE. This leads to stronger US demand and a surge in Chinese exports. Let's look at the global reaction to China's weak currency. As Haier products gain a price edge, US manufacturers face growing pressure. In response, the US demands that China revalue the yuan to level the playing field. Let's see what happens if China revalues its currency. At the new rate of 6.5 yuan per dollar, Haier's 3,900 CNY product returns to $600, same as GE. This cancels Haier's price advantage and reduces export momentum. Let's summarize the impact of revaluation. With the yuan stronger, Haier's price rises to match GE's, erasing its cost advantage. This shift gives US manufacturers a better chance to compete. Let's begin with the two core forces behind exchange rates. Prices and interest rates interact over different time horizons to influence currency values. Together, they shape both short-term volatility and long-term trends in exchange rates. Among the key factors, let's start with prices. The law of one price states that identical goods should sell for the same amount globally when expressed in a common currency. If not, arbitrage occurs as buyers shift toward the cheaper market. Let's apply the law of one price to a real product. In Korea, the Galaxy S24 Ultra sells for 1.6 million won, or about $1,230. In the US, it costs $1,300, equal to 1.69 million won, revealing a price difference. Now let's see what happens when prices differ. Since the Korean price is lower than the US price, consumers may try to buy the phone in Korea and resell it in the US. This arbitrage behavior creates pressure for prices to converge. Let's see how arbitrage closes the price gap. As more people buy in Korea and sell in the US, Korean prices rise while US prices fall. Eventually, prices converge, eliminating further arbitrage opportunities. Now let's move from prices to purchasing power. Purchasing power parity predicts that exchange rates adjust to equalize the cost of a standard basket of goods across countries. This means currencies should reflect differences in national price levels over time. Let's compare product basket prices in both countries. In the US, a standard basket costs $100 or 15,000 yen at 150 yen per $1. In Japan, the same basket costs 12,000 yen or $80, revealing a price level gap. Now let's see how price gaps influence trade. Japanese baskets are cheaper, making their goods more attractive to foreign buyers. This leads to more Japanese exports and increased imports into the US. Let's focus on the Japanese side of the market shift. As Japanese consumers buy fewer US goods, they need fewer dollars and sell less yen. This decreases the supply of yen in the currency market. Now let's examine how US consumers respond. To buy cheaper Japanese goods, Americans sell dollars and purchase yen. This increases yen demand and adds more dollars to the currency market. Now let's see how these currency flows move the exchange rate. As yen demand rises and dollar supply increases, the yen begins to appreciate against the dollar. This appreciation reflects the shifting balance in the currency market. Let's confirm how appreciation restores balance. The exchange rate adjusts from 150 yen to 120 yen per $1, aligning prices across both countries. As the gap disappears, arbitrage ends and purchasing power parity is fully restored. Before linking inflation to exchange rates, let's define it. Inflation is the erosion of purchasing power, often caused by an imbalance between demand and supply. This imbalance may stem from government policies or shifts in market conditions. Inflation comes in two main forms. Demand-pull inflation arises from excessive demand, while supply-push inflation results from rising costs or supply constraints. Both types drive prices upward and influence the value of a country's currency. Let's break down how inflation develops from different causes. Demand-pull inflation is triggered by rising demand supported by fiscal or monetary expansion. In contrast, supply-push inflation stems from higher production costs or supply shortages. Let's look at how fiscal policy can trigger inflation. Two common tools are tax cuts and direct stimulus spending. These policies increase purchasing power and lay the groundwork for rising demand. Now let's see what happens after fiscal stimulus takes effect. Tax breaks and government spending increase household income, boosting consumption. This rise in demand drives prices higher, fueling demand-pull inflation. Let's now turn to the role of monetary policy. When interest rates are cut, borrowing becomes cheaper, leading to more loans. This credit expansion increases spending and pushes prices upward. Let's examine how central banks inject liquidity. Under quantitative easing, the central bank buys government bonds from commercial banks and credits them with cash. This injects reserves into the banking system and prepares the ground for more lending. What happens after banks receive new cash? With more reserves, commercial banks increase lending to households and businesses. This surge in credit fuels demand and adds upward pressure on prices. Let's now look at inflation driven by supply constraints. Supply-push inflation often begins with shortages in key inputs. Two common triggers are raw material scarcities and labor supply disruptions. What do firms do when their input costs rise? To protect margins, they raise prices and pass costs onto consumers. This creates inflation without an increase in overall demand. Let's see how inflation affects trade and currency values. High inflation raises domestic prices, making exports less competitive and imports more attractive. As people demand more foreign goods, they buy foreign currency, causing the domestic currency to depreciate. Let's examine how interest rates compare between countries. Korea lowers its interest rate from 5% to 1%, while the US maintains its rate at 5%. This shift creates a difference in interest rate environments between the two countries. Let's see how interest rate cuts affect the economy. As Korea lowers its rate from 5% to 1%, borrowing becomes cheaper and loans increase. This boosts consumer demand within Korea and puts upward pressure on prices. Let's examine how domestic demand changes relative prices. In Korea, the basket price rises from 130,000 won to 150,000 won due to increased demand. In the US, the same basket remains steady at $100, or about 130,000 won at the current exchange rate. Let's see what this price gap means for trade. Korean consumers now find US goods cheaper, as $100 is still worth 130,000 won, while local prices rose to 150,000 won. To buy more US goods, they convert won into dollars, raising demand for dollars and weakening the won. Let's shift our focus to US consumers. As the Korean won weakens, Korean goods become more expensive for Americans. This leads US consumers to reduce their purchases, lowering demand for the won. Now we see how the currency market reacts. The supply of won exceeds demand, while demand for dollars rises. This imbalance causes the won to depreciate from 1,300 to 1,500 won per dollar. Let's see how the new exchange rate restores balance. With the won now at 1,500 won per dollar, Korea's basket at 150,000, won again equals $100. The price gap disappears, demonstrating how exchange rates realign to equalize purchasing power. Let's explore how interest rates influence short-term exchange rates. When a country lowers interest rates, its bonds become less attractive to investors. This prompts capital outflows in search of higher yields abroad, increasing foreign currency demand and causing the domestic currency to depreciate. Let's compare how interest rates move in each country. Korea lowers its policy rate from 5% to 1%, sharply reducing domestic bond yields. Meanwhile, U.S. rates remain unchanged at 5%, keeping American bonds attractive to investors. Let's see how investors respond to changing yields. As Korean bond yields fall, investors reduce demand for Korean assets. At the same time, stable U.S. rates attract more capital into dollar-denominated bonds. Let's follow how capital flows affect the currency market. Korean investors sell low-yielding Korean bonds and exchange won for dollars to buy higher-yielding U.S. bonds. This increases the supply of won and the demand for dollars, creating pressure for exchange rate movement. How do U.S. investors react to Korea's rate cut? Lower yields on Korean bonds make them less attractive to U.S. investors. As a result, they sell Korean assets and convert won into dollars to reinvest in the U.S., where yields remain higher. Let's observe the exchange rate adjustment. Massive capital outflows and rising dollar demand cause the won to weaken sharply, moving from 1,300 to 1,600 won per dollar. This overshoots the PPP-based equilibrium of 1,500 won, showing how financial markets react more aggressively than trade fundamentals suggest. Exchange rates respond to policy changes over time, not all at once. When interest rates shift or expansionary policies are introduced, the exchange rate moves through three phases: short-term, mid-term, and long-term, each driven by different economic forces. For example, the Bank of Korea cuts interest rates from 5% to 1%. Let's focus on how bond markets respond to interest rate changes. As the Bank of Korea cuts its rate from 5% to 1%, Korean bonds become less attractive. Meanwhile, U.S. bonds still offer 5%, drawing investor demand away from Korea. Now we see how capital flows react to yield differences. Investors exit Korean bonds and exchange won for dollars to chase higher returns abroad. This surge in dollar demand weakens the won sharply, pushing the exchange rate to 1,600 won per dollar. Now begins the midterm adjustment phase. At 1,600 won per dollar, Korean exports become cheaper for foreign buyers, while imports grow more expensive. This boosts demand for Korean goods and restores some demand for the won in currency markets. Midterm forces begin pulling the exchange rate back toward balance. Improved trade flows increase demand for Korean exports, generating more won purchases. This drives the exchange rate down from 1,600 won to 1,500 won per dollar, closer to the purchasing power parity level. In Korea, low interest rates trigger long-term domestic adjustments. With borrowing costs down, Korean consumers and businesses increase loans, boosting spending and investment. This rising demand pushes up prices across the Korean market. As inflation sets in, Korean products become more expensive relative to U.S. goods. The earlier price advantage fades, and Korean exports lose some of their global competitiveness. This sets the stage for the final adjustment in the exchange rate. Higher Korean prices lead to reduced export demand. As fewer foreign buyers purchase Korean goods, demand for the won weakens. The exchange rate rises again, stabilizing at a new long-term equilibrium. Let's pause and identify the key insights from the three-phase adjustment process. In the short term, the bond market reacts immediately to the interest rate cut, triggering exchange rate overshooting to 1,601 per dollar. Let's now look at the mid-term adjustment. The trade sector takes more time to respond, but as Korean goods become cheaper, foreign demand increases. This leads to a partial correction of the exchange rate to 1,401 per dollar. Finally, let's look at the long-term effects. Over time, low interest rates fuel loan growth and domestic demand in Korea. As prices rise, Korean goods lose competitiveness, and the exchange rate climbs back to 1,501 per dollar. Let's recap how the exchange rate adjusted across the short, mid, and long term. In the short term, bond markets reacted immediately to the interest rate cut, causing the exchange rate to overshoot to 1,601 per dollar. Over the midterm, trade flows gradually adjusted, increasing demand for Korean goods and partially correcting the rate to 1,401 per dollar. In the long term, rising inflation in Korea weakened export competitiveness, and the exchange rate eventually stabilized at 1,501 per dollar. Let's move on to the conclusion. Exchange rates are more than just numerical indicators. They are dynamic forces that influence how trade, investment, and global competition unfold. Understanding them is key to understanding the global economy itself. Even small shifts in currency values can reshape business outcomes. From gaining a price edge in exports to losing profits when repatriating earnings, companies must navigate a world where currency movements can change everything. Behind each movement in exchange rates lie deeper macroeconomic forces. Inflation, interest rates, and purchasing power act over different time horizons, causing ripple effects that reshape markets over time. A deep understanding of these interconnected forces empowers firms and policymakers. It helps them anticipate risks, respond to volatility, and seize global opportunities in an ever-changing economic landscape. Let's review why exchange rates are central to global business. When a currency weakens, exports become cheaper and more competitive, while imports grow costlier. Governments can intervene through devaluation to lower their currency's value, or through revaluation to raise it. Businesses and investors rely on different tools to forecast currency movements. The efficient market view assumes that all public information is already reflected in currency prices. In contrast, the inefficient market view suggests room for informed forecasting. Fundamental analysis uses economic indicators and models, while technical analysis looks at historical price trends and charts. Exchange rates are driven by a mix of pricing theory and macroeconomic forces. According to the law of one price and purchasing power parity, identical goods should have the same value when prices are expressed in a common currency. Inflation erodes purchasing power, and interest rate differences often reflect inflation expectations. A country with higher inflation than its peers is likely to see its currency depreciate. Thank you for watching. Stay tuned for more insights from Essential Biz Marketing.